All right, today we're doing something a little different. Think of it like a financial detective story. We are going to follow the clues left by one single, absolutely massive trade to figure out how the pros make these huge, directional bets with just incredible precision and, maybe more importantly, efficiency. So here's the big mystery we're trying to solve. How in the world does someone bet hundreds of millions of dollars that a stock is going to go up, but do it in a way that costs them almost nothing upfront and clearly defines their risk? Well, our investigation is going to start with the very first clue.
And boom, here it is. On December 8th, someone somewhere spent a whopping $7.2 million in one shot. They were betting that shares of the pharma giant Merck were about to go way, way up. You know, a trade of this size, it's not a whisper, it's a giant signal flare lighting up the entire market. It basically screams, hey, you need to pay attention to this.
So let's put on our detective hats and start digging into the evidence. What exactly did this trader, this whale as they're called, actually buy? Because the details, well, they tell us everything about what they were thinking.
Okay, let's break this down. We're looking at 30,000 call option contracts. A call option, simply put, is a bet that a stock is going to go up. This one single trade controls the equivalent of 3 million shares of stock, which is worth around $300 million. Now, a move this big isn't just some simple little hedge, no way. This screams high conviction. This is a targeted, laser-focused bet that Merck's stock is about to take off.
And here's where it gets really interesting. This trader needs Merck to climb from around $100 to over $110 by April of 2026. So, why that specific date? It's not random. Not at all. It lines up perfectly with huge events for the company. We're talking earnings reports, major clinical data announcements, you name it. You see, this whale isn't just betting on if the stock will rise. They have a very clear idea of when.
Let's move on to the next set of clues, because this is where the story really builds. Why December 8th, specifically? Trust me, the timing was no accident. It was a totally calculated move, based on some classic signals right there on the stock chart.
So the first technical clue is something called the 21-day exponential moving average, or EMA. The easy way to think about it is as a guide for the stock's short-term momentum. And on the exact day of this trade, Merck's stock had pulled back and just kissed that line for the first time in a month. For pros, that's a blinking green light. It is the classic buy the dip signal, the perfect moment to get in on a stock that's already in a nice uptrend.
But the second clue, honestly, it's even more important. It's the 200-day simple moving average, and it was sitting way down at $85. Now, for a blue-chip, rock-solid stock like Merck, this line isn't just a guide, it's a fortress. It's a huge long-term support level, where big institutions, the big money, they see incredible value and they are known to just step in and buy with both hands.
And this quote just says it all. It gets to the psychology of it. The smart money doesn't see a drop to this level as a problem. They see it as a gift. It's a chance to load up on a high-quality company at a discount. And you have to remember that belief, because it is the secret key to the entire strategy we're about to unpack.
Okay, so we know when the trade was placed. We know the technical levels they were watching. But why? Why make such a gigantic bet on Merck in the first place? What's the fundamental motive here?
Well, it turns out Merck is just firing on all cylinders right now. They've got a new blockbuster drug, Winrevair, that is just blowing away all expectations. Their main cash cow, the cancer drug Keytruda, is still a resilient cash-printing machine. And they have a deep pipeline of future products, including what could be a holy grail pill for cholesterol. This is definitely not a company that's running on fumes.
And get this, our whale isn't some lone wolf here. Just 3 days before this monster trade went through, a major Wall Street firm, Guggenheim, raised its price target on Merck all the way up to $122. So our trader, they were acting just ahead of this bigger shift in what the market was thinking.
Okay, we've gathered all the evidence. We've got the size, the timing, the motive, it's all here. So now for the big reveal. How did this whale actually structure the trade to get the absolute maximum bang for their buck?
So the strategy has this kind of fancy name. It's called a split strike risk reversal, but it's really just a brilliant two-part move. First, they bought that call option, right? The simple bet that the stock is going to go up. But then, and this is the genius part, to help pay for it, they sold an $85 put option. Now, selling a put is basically you agreeing to buy the stock if it drops down to that lower price. And in return for taking on that obligation, you get paid cash right up front. And that cash makes your bullish bet way, way cheaper. And right here, this is the aha moment. To go out and buy just 100 shares of Merck stock would cost you almost $10,000. But by using this professional option strategy, our trader gets exposure to all that same upside potential for a net cost of just $64. That is just unbelievable capital efficiency.
And you can really see the power of this structure right here. The cash they collected from selling that put option, the one anchored way down at that fortress level where they'd be happy to buy the stock anyway, it paid for almost 3/4 of their entire bullish bid. It's like getting a 73% off coupon for a trade that has unlimited upside. It's just incredible.
So let's get to the final verdict. What makes this trade structure so powerful, so smart, is something called an asymmetric risk profile. The risk and reward are beautifully lopsided.
Let's just walk through the outcomes. If Merck soars past about $110, the profit is unlimited. The sky is the limit. Now, if the stock just kind of chops around or even goes down a bit, anywhere between 85 and 110, the maximum loss is just that tiny $64 they paid. And the only real risk, if you can call it that, comes if the stock totally crashes below 85. At that point, they have to buy the stock, but at a price they already decided was a gift.
So what this all boils down to is a massive margin for error. This trade has a built-in 15% cushion. The stock has to fall significantly. It has to break right through that institutional fortress we talked about before this trader is on the hook for anything more than their tiny initial cost. It is the very definition of a bet with limited downside and absolutely explosive upside.
And that really brings us to our final takeaway. Following these whales can reveal some powerful strategies, for sure. But the real alpha, the real edge, isn't just the trade structure itself. It's a mindset. It's about identifying high-quality companies, waiting patiently for those precise entry points, and then structuring a bet where the potential reward just dwarfs the potential risk. And the question that leaves us with is, where's the next one hiding?